Welcome to Iraqi Dinar Hub, where we analyze developments and discussions across the currency landscape. Today, our attention shifts toward a significant emerging narrative that has drawn increasing interest from global market watchers. While various currencies around the world receive periodic attention, a rapidly evolving story involving the Vietnamese Dong has become a focal point in many financial conversations. A growing wave of reports and commentaries suggests that the Dong may now be positioned at the center of a fresh and potentially meaningful revaluation dialogue. This uptick in discussion has revived optimism among longtime observers, particularly those who have held physical notes in anticipation of a long-theorized strengthening. As with all matters related to international foreign exchange, discernment is vital. One must move past rumors, contrast speculation with observable trends, and examine what may truly be taking shape. In this analysis, we will break down what is genuinely being reported by economists, traders, and regional specialists. Although speculation is widespread, our goal is to anchor the discussion in verifiable information. We will look closely at the possible actions taking place within Vietnam's central bank, State Bank of Vietnam, SBV, and explore their historical approach to currency management to contextualize any potential changes. Additionally, we will assess what this narrative could mean for investors, businesses, travelers, and international markets. This is far more than a localized development. It reflects shifting dynamics within the global monetary order and warrants a thorough, step-by-step review, grounded in credible insights rather than sensationalism. The current wave of attention stems from a blend of observations made by foreign exchange traders, economists, and analysts who specialize in Southeast Asian financial systems. These professionals are engaged in active debate as speculation grows that the Vietnamese government may have quietly adjusted its official exchange rate or is laying the groundwork for an upcoming shift. This possibility has sparked intense conversations in trading rooms and online financial communities regarding whether a central bank-driven revaluation could be underway. The mere concept of a revaluation carries weight in these circles, as it implies a formal, government-supported strengthening of the national currency. Such a move is often seen as a clear acknowledgement by policymakers that the country's economic foundations have become notably strong. The immediate spark for all this debate seems to be tied to recent economic data emerging from Vietnam. Several reports indicate that the Dong's reference rate, a critical instrument used by the SBVAs, displayed more variability than usual in recent weeks. This break from its traditionally steady pattern has prompted market observers to question the central bank's intentions. Are these temporary fluctuations, or the initial steps in a methodical strategy by the SBV to permit the currency to appreciate more freely against others? This key question lies at the heart of the current discussion as analysts attempt to interpret whether deeper policy adjustments may be influencing these subtle shifts in daily exchange management. To fully appreciate the significance of these modest movements, one must first understand Vietnam's broader monetary history. For many years, the nation has prioritized gradual, carefully measured financial decisions aimed at protecting macroeconomic stability and fostering a predictable environment for investment and trade. Sudden or dramatic adjustments are not typical of the State Bank of Vietnam's strategy. This cautious approach has been central to Vietnam's economic rise, especially in establishing a strong export-oriented manufacturing base. Yet it is the timing of the recent currency activity that has caught the attention of seasoned analysts. These emerging shifts are occurring alongside Vietnam's robust export expansion, its increasing foreign reserve accumulation, and its consistently well-managed inflation levels. This favorable economic context has strengthened the belief among observers that a controlled appreciation may now be both attainable and potentially aligned with the government's evolving objectives. This naturally leads into a closer examination of how the Vietnamese Dong actually functions in practice. Vietnam operates under a managed float currency regime, not a freely floating system like the euro or the US dollar. The SBV establishes a daily central reference rate and allows the Dong to fluctuate within a narrow percentage band, generally about 5% above or below that benchmark. This carefully constructed framework aims to balance market influence with policy oversight. It permits pricing based on supply and demand while preventing extreme volatility that could disrupt Vietnam's critical export sector or undermine domestic financial stability. For years, this managed float system has been an essential component of Vietnam's financial architecture. It has helped keep the dong relatively stable even during periods marked by global economic uncertainty. This stability has ensured predictability for exporters and supported competitive pricing for Vietnamese goods in international markets. As we move through late 2025, the exchange rate has hovered near 24,000 dong per US dollar, a level that represents both continuity and potential transition. Market analysts closely monitoring recent behavior have noted that the dong has shown small yet steady signs of strengthening across multiple exchange channels. These subtle but consistent developments are increasingly interpreted as more than routine market fluctuation. Many market watchers view them as possible indicators of a shifting policy direction. Even slight modifications to the reference rate or adjustments to the trading band, especially when paired with Vietnam's powerful macroeconomic momentum, can imply broader underlying intentions. Some experts speculate that the SPV may be preparing to gradually modernize its currency framework, tuning it to better reflect Vietnam's rising economic prominence and expanding global role. This would represent a rational evolution, one that aligns the nation's monetary regime with its maturing economic status and expanding influence within global supply chains and trade networks. There are several compelling reasons why Vietnam may be evaluating a shift toward permitting a stronger currency at this particular juncture. Over the past decade, the country has undergone a remarkable economic transformation, shifting from an emerging market into one of Asia's most dynamic and rapidly advancing economies. A major driver of this progress has been the significant inflow of foreign direct investment. Corporations from the US, South Korea, Japan, and European nations have invested heavily in Vietnam, building large-scale industrial parks, modern manufacturing complexes, and cutting-edge technology production facilities. This capital influx represents a powerful vote of confidence in the country's stability, skilled labor force, and strategic geographical position. The result has been an impressive expansion of Vietnam's export capabilities. The nation has become a manufacturing powerhouse in electronics, textiles, machinery, and footwear. Its robust export performance has produced persistent trade surpluses, sending a continual stream of foreign currency, primarily US dollars, into the Vietnamese economy. This trend has helped build large and resilient foreign exchange reserves, granting the government a high degree of financial security. These strong fundamentals provide a foundation for any possible upward shift in the dong's value. Beyond trade, Vietnam's internal economy remains vibrant. Rapid GDP growth, rising domestic consumption, and expanding infrastructure investment all contribute to a solid macroeconomic environment. Under these conditions, market forces typically place upward pressure on a currency. Thus, many economists argue that the dong appears undervalued at current levels. A managed appreciation could offer several benefits by signaling economic strength, enhancing global credibility, and lowering import-related inflation risks. However, policymakers must carefully weigh these advantages against the need to maintain export competitiveness, a balancing act. Vietnam's central bank has historically approached with caution and long-term vision. Vietnam faces a complex challenge in determining how quickly or slowly to allow its currency to strengthen. While a more valuable dong could reinforce the country's economic reputation and provide tangible benefits such as reducing import prices and keeping inflation under control, it could also pose risks to its export sector. A rapid or excessive appreciation would make Vietnamese goods more expensive abroad, potentially slowing the manufacturing sector that forms the backbone of the economy. For this reason, analysts widely expect that any appreciation, if indeed underway, would be implemented gradually and deliberately. This would not resemble the sudden, sweeping reevaluations that some countries have executed in past decades. Rather, it would reflect a measured, phased strategy shaped by real-time data and market testing. The recent signs that traders are noticing may therefore represent only the opening steps of a longer-term process. Such a process could be designed to slowly transition the dong toward a more market-responsive valuation, albeit under the close guidance and timing preferences of the Vietnamese authorities. For individuals holding Vietnamese dong in anticipation of future appreciation,